Hey, what's up, guys? Welcome back to the channel. My name is Frank Mularcik, and in this episode of the Investing Strategies podcast, we had on a very special guest, Tom, from the Investing with Tom YouTube channel. Tom has a very fundamental style of investing that is reminiscent of some of the greats that he has learned from, such as Charlie Munger, Warren Buffett, Phil Town, and the like. So I had a super fun conversation with Tom, and I learned a lot, and I hope you enjoy it as well. Welcome, everyone. Today we have Tom from the Investing with Tom YouTube channel, and just gonna talk a little bit about investing and kind of how he goes about that. So, thanks for coming on, Tom. I really appreciate you taking the time for that. And just feel free to introduce yourself however you like, and then we can kind of dive in a little bit.
Yeah, sure. Thanks for the invite. So I'm Tom. I run the Investing with Tom YouTube channel and podcast. Been doing that for about 4 years now. Based down here in little old New Zealand. So there's not a lot of probably value investing YouTube channels and that sort of thing in this part of the world. But yeah, it's been an enjoyable few years, kind of putting content out there. And we were talking a little bit before we started recording here. It's cool to just kind of put stuff out there into the world and meet people and learn things and all that sort of stuff. So yeah, that's a little bit about me.
Yeah, so I guess the first thing I like to talk about is, how you got into investing and kind of what your, I guess, goals were initially for that.
Yeah, sure. I think I probably went through like a thought process that a lot of people go through when they first get started in a professional career. I was fresh out of university. Was starting to save money for the first time, like was going from a negative net worth, having left university with a student loan and having no money, and was starting to come out of that hole and save up a little bit. And as obvious as it sounds, I was just doing some really basic, like back of the envelope calculations on, if I work for 40 years and I save this much per year, what am I going to end up with at the end? And then, you know, uh, I guess all the really conservative non-investing types always talk about, you got to live off the interest or whatever. So I was doing very basic calculations like that about, okay, how much am I actually going to have to live when I'm older? And the numbers were really lackluster when I went through that calculation, and I pretty quickly figured out that I'd forgotten to earn any sort of return on my money that entire process. So quickly discovered investing. In New Zealand, there's a really big real estate investing community. I think we've probably got one of the most expensive real estate markets in the world, although there's a lot of kind of tax reasons that people tend to push themselves more towards real estate than investing in shares, particularly internationally. So there wasn't a whole lot of options for me to get into real estate at the time. I just had no money, basically. So pretty quickly discovered that you can put smaller sums of money, towards investments in public companies, pretty much. And from there, kind of went in the rabbit hole of discovering Buffett and Munger, and I found Phil Town reasonably early on, who was a good start to kind of get me going with the basics of value investing. So yeah, that's sort of how I got going from there. I think that was all probably around 2017. So I started the YouTube channel maybe a year into the whole investing journey.
So you said you kind of like discovered those investors like Warren Buffett, Charlie Munger, people like that. Did you kind of like look to them to kind of learn how to invest or learn what you were doing, I guess?
Yeah, for sure. I mean, I started out with the absolute basics. So, reading like Rich Dad Poor Dad, for example, where it talks about assets are things that put money in your pocket, and you should try to accumulate those over time. So yeah, I started with the absolute basics. Pretty quickly discovered that Buffett and Munger are kind of the best to ever do it, and then went out and actually read The Intelligent Investor, I think, which was pretty heavy for someone like completely new to investing in stock markets.
Yeah.
And then again, Phil Town kind of books were really useful just to strip it right down to the basics, like take the Buffett and Munger approach, simplify it somewhat, and put it into like smaller actionable steps, and then you kind of graduate from that over time. But that's sort of how I got started.
And how did your have your goals like changed any, or is it kind of all towards like um, retirement, I guess, or you know financial independence type thing? Is that kind of where you're heading?
Yeah, yeah, for sure. I mean, the goal has never been to have a huge garage full of Ferraris or anything. The goal is to basically have flexibility and, the ability to work if I want to and not work if I don't want to. Kind of getting to that level of financial freedom. So, um, yeah, initially I was looking at that through a retirement lens. I think I can see a path towards ticking that goal off a lot sooner than being in my 60s. So if I can get to that point, at a younger age, that would be really cool. So that's still the goal.
Yeah, that's good. So I guess let's talk a little bit about your actual investing strategy and how you go about like looking at companies and deciding what you want to invest in. So I guess is there anything you look at like um, initially to sort of like screen companies, or how do you come up with ideas, if that makes sense?
Yeah, I used to do a little bit of screening, but I really don't do that much anymore. One of the benefits, I guess, of just putting my own personal investing thoughts out there is I'm actually getting investment ideas kind of thrown at me all the time in YouTube comment sections and on Twitter and through emails and all sorts of stuff. So that's actually quite a nice way to have a bit of idea flow, I suppose. But I don't really screen for things. I guess what I'm fundamentally trying to find is either a good business that's trading for less than it's probably worth, or a not so good business that's trading exceptionally cheap, like the classic 50 cent dollar kind of asset. So I'm looking for one of those two things. Sometimes, in more extreme circumstances, like I'm sure if I was to run a screen during the financial crisis or during March, April 2020, I would find those things just running screens because the market generally has gone down a lot. But in normal times, I think there's often off financial statement value and things that just don't screen well. So typically it's kind of just looking through individual company by individual company, trying to understand, different types of businesses. And it doesn't happen all that often, but once or twice a year, maybe if I can find a new investment, that's pretty much good enough for me. And if you look at enough stuff through a year, occasionally you have something really interesting just kind of smack you over the head. So that's the general approach.
Yeah, that makes sense. Is it sort of mostly a lump sum approach for you? You kind of like find, some stock you want to invest in and then just put some money in it and just let it sit for a while?
Essentially, yeah. I mean, if I wasn't as interested in investing, I'd probably be someone just dollar cost averaging into ETFs or something. I think that's a really good approach. But I like to look for individual companies. So I kind of just, um, work and save and, live on less than I earn and all that basic stuff for most of the time. And then when I find something interesting, I hopefully have, the cash there to do something and put a reasonably significant sum of money for me at least to work. And then I just repeat that process basically.
Yeah, that makes sense. What is your, I guess, do you have like any hesitations in your mind about just like stacking up that cash? Because for me, it always just feels like you're just losing to inflation. But again, there's the like opportunity cost as well, is that if there's an opportunity there and you're not prepared, then you can't take advantage of it. So is there any hesitation like in your mind that you have to fight back with that?
Occasionally, I think less so now, but certainly there was in, um, only a year ago when kind of everything was just going up, and it was
Yeah.
difficult to find stuff, and we were starting to see initial signs of inflation. Those were really difficult circumstances to kind of sit on cash, but I guess we're not really looking for a dollar trading for 95 cents or anything. We're looking for like really attractive opportunities. So if you can find one of those and it works out as expected, I think the gains you can generate from those investment ideas more than offsets hopefully the bit of inflation that happens in 6 months or something like that. Um, And the equation's changed a little bit for me recently. We've just actually bought our first home and have debt, material debt for the first time. So um, I guess I'm technically fully invested now because I have net debt. So yeah, I'm not as concerned about having piles of cash sitting around getting getting inflated away. I now have debt that I'd like to see inflated away. So it's flipped a little bit.
Yeah, that makes sense. Um, One thing I was going to ask you was about, uh, looking at specific investments and how you kind of evaluate those. So, I saw in one of your recent videos you were talking about, you invest mostly in, you know, you don't really invest in like quote unquote large cap companies like under a few $1 billion market cap. So I guess maybe you walk us through why that is and your kind of thoughts on that.
Yeah, I definitely do have large cap investments. I have one
Okay.
stock that's has a market cap in the hundreds of billions of dollars. I don't have anything in the trillions, I don't think. But yeah, most of the companies I'm invested in are in the single billion kind of single digit billion kind of dollar market cap range. I'd be open to investing in smaller stuff. I ended up passing on it in the end, but I was very close to buying into an Australian oyster farmer last year that had a market cap of I think $15 million or something, and it actually got bought out about a week after I passed on it, which was just and suddenly shot up like 50% or something. So that was just kind of a bit of bad luck, I guess, on my part, not capturing that. But I'll look at things across the spectrum. I try not to be biased towards or against any particular market cap range. I guess the general logic of focusing on slightly smaller things is that I'm looking for mispricings, and if if I find a company that has like one analyst or two analysts following it, or no analysts following it, it's much more likely to be mispriced than, Microsoft with, I don't even know how many, 50 or 100 people following it very closely and looking at minute detail at how the business is performing. And it's not to say those things can't get mispriced. I mean, we saw Buffett make like $100 billion on Apple over the past 6 years.
Yeah.
So it can certainly happen, but I think the odds are more in your favor of finding interesting opportunities, kind of the smaller down the market cap range you go.
Yeah, that makes sense. So when you're kind of analyzing a business, what are the primary things you look at, or is it kind of on a does it kind of depend on what type of business there are, or there are certain things you kind of look at across the board and have a good understanding of?
Yeah, sure. I think there's a very basic framework, which is still, to be honest, like the Phil Town approach that I learned a few years ago, which is his 4M checklist of meaning, moat, management, margin of safety. So, do you understand the business? Does it have sort of some sort of competitive advantage? Competitive advantage. Is it well managed, and did the management team have integrity? And is it undervalued? That's the very basic checklist, and it's definitely got more nuanced over time, and the way I approach each of those aspects can vary from company to company, and that sort of thing. But that's still the very basic framework. Like, yeah, do I understand the business is the first filter, and I throw a lot of stuff out right at the start because it's some weird biotech company or whatever, and you do get things into your circle of competence over time, just as you naturally learn about new industries or whatever. But that's still kind of the first threshold, and then I start working down the rest of the list pretty much.
Yeah, that makes sense. One thing I feel like I don't have a very good understanding of is like how to evaluate management or understand whether they're doing a good job. So what are things you look at in regards to management or how well you think management is doing?
Yeah, that's a tough one. I think the ideal would be to find businesses where management actually doesn't matter that much. If you can have a business with a like massive structural advantage, you can afford to have not the best management in the world, I suppose. Like Buffett always talks about a ham sandwich could have run Coca Cola for a long time there. So if you can find a good enough business, then it becomes less important. But I think there's no real concrete answer to that. There's we're dealing with humans here, and humans can do weird, irrational stuff from time to time, even if they've never done it before. So it's hard to have a lot of certainty, although I think probably just looking at previous track records is the best way to go. Um, if someone has been the CEO of a company for 10 or 20 years and the track record of that company is good, that's a pretty good sign. Even if they're a new CEO, often they've, stepped up from some lower down role internally in the company that you might be able to do some digging on. Maybe they've come from a different business that you can do some digging on. Those are the types of things that I would tend to look at. And then there's the whole monger idea of show me the incentive and I'll show you the outcome. So it's reasonably easy to look at like the quantitative incentive programs for management, whether they're getting paid a bunch in cash, whether they're getting paid in stock. If they are getting paid stock options or big bonuses, how are those structured? Is it based on things that are going to be accretive to shareholders long term, or are they incentivized to do something that might look good for the business in the short term but potentially harms the long term outcomes of the business? Those are all things that I'm weighing up, but I really don't think there's a super easy answer on the management one.
Yeah, I think that makes sense, because if there was an easy answer, I probably would have not been uncertain about it, I guess, as
Yeah.
much, or been able to find something more concrete. Um, do you invest in, anything outside of stocks, really?
Well, we've just bought our first home, so that's a pretty material part
Yeah,
of what
yeah.
we're doing now. Um, Outside of that, it's really just stocks. I think over time I'd be open to buying private businesses, in my local town and that type of stuff. I'm not closed off to doing that type of thing. I've actually hunted around the odd kind of small business um, investment case just on online listings and that type of stuff. And there is actually some interesting stuff out there, although that could be a place where finding good management, I suppose, is hard to track down, and I don't want to be really running those businesses day to day or anything. But as it stands right now, it's stocks and the one real estate property which we're currently living in, and over time, I'd like to get most of our equity towards stocks. I like the lifestyle part of having a house and having your own space and all that, but I'm not that excited about the financial aspects of it, to be perfectly honest.
Why do you say that? I think that's
Um,
interesting.
Yeah, I say that because house prices in New Zealand are very expensive compared to almost anywhere else in the world. And I think it was Monish Prabhai used to tell the story about real estate versus stocks, and there are definitely like structural advantages that you can get in real estate that you can't get in stocks. Like you can get um, you can take advantage of leverage, for example, over the long term in a way that you can't in stocks. But Monish Prabhai used to tell this story of, imagine if you owned $1 million house and you had a friend who was a real estate agent, and you said, Mr. Real Estate Agent friend, I'm going to take you out to breakfast every morning. It's completely on the house. I'll pay for everything. The one condition is you have to tell me what my house is worth. And if you did that every single day, the real estate agent would think you're a complete moron because, he'd tell you yesterday it was worth $1 million. You'd take him out to breakfast again today. He'd say, I don't know what you're talking about, Tom or Monish. It's still worth $1 million. You take him out the next day or next week, and maybe he says, "Oh, it's gone up a little bit. Maybe it's 1,050,000 or something, or it's gone down a little bit and it's 980,000." But the point is, the price doesn't move around all that much, and typically, unless someone's going into bankruptcy or something, it's a relatively rational seller talking to a reasonably rational buyer. So there's not going to be significant mispricings. Whereas if you look at stock markets, just look at a basic 52-week range on any old company, you're going to see huge variation that you would never see in real estate. And I think if you can understand what that particular asset is worth, what that company is worth, the wild volatility in prices can provide a lot of opportunity, and you just don't get that in real estate. Um, and if you find a particular sector that you really like in the stock market and it happens to be expensive, you can go on to another sector. And that just doesn't really happen in real estate. if real estate's expensive, it tends to be expensive generally.
Yeah, I think that's a good point. So when you're, I guess, investing in stocks, you're mostly, you have a fundamental approach, you would say, right?
Yep, for sure.
Okay. Yeah, and what is your kind of what kind of things are you looking at, like specifically? Like, do you kind of like look super in depth, like through a company's 10K, or like how deep, I guess, do you go on things?
Yeah, I think it all comes back to, at the end of the day, I'm trying to figure out what something's worth. So that usually requires understanding a few different dynamics about how the business operates. In some situations, that can be quite straightforward. Like a company I've covered on the channel, on my YouTube channel, a bunch is Seritage Growth Properties, which is a pretty simple collection of different bits of real estate. And you just kind of need to figure out what all those parcels of real estate are worth and back out the debt. So that's a pretty straightforward equation. But others, there's more moving pieces. So I have another company, and these aren't recommendations or anything, but I have another company in my portfolio, Thor Industries, which is a wholesaler of recreational vehicles, basically. So there's a lot more moving parts there, where they have a towables segment, they have a motorized segment, they have a European business, a US business. They wholesale to dealers. The dealers then have a business where they sell to the end consumer. Thor also has some parts businesses, and they're developing a mobile app across all their brands. And there's just a lot more moving pieces you kind of need to get your head around. Um, that's also a situation where you might look at long term, like industry growth trends. What is the number of wholesale RV units done over time? Has it gone up or down or sideways or whatever? Um, so yeah, the process can kind of vary from company to company, but I'm trying to figure out, where's this business today? Where do I think it can conservatively be in 5 or 10 years' time? And what does that mean for the investment case? What could that business be worth in a few years' time versus what I'm paying today? Um, and if something goes wrong and I've completely messed up my analysis, what's the downside as well? I'm trying to figure out both aspects of that. So the process can vary a little bit.
Yeah, I think that makes sense. Do you kind of look at any more uh, kind of like macro stuff, like with maybe specific legislation that may be getting passed? Like, for example, that chips bill in the U.S. Congress, like that could potentially affect like a lot of semiconductor companies, right? Do you kind of pay attention to that stuff, or do you kind of just like look at the fundamentals and not really worry?
Yeah, I would like to say that I focus almost entirely on the micro, although with that specific example you just mentioned, that is something that could have a material impact on those businesses. I'm assuming I actually don't follow the chip space particularly closely.
Yeah, I'm not.
Um,
That's just
but
something that came to mind, I guess. But
yeah, I mean, I don't think I've ever invested in a situation where that type of stuff has been super relevant. Although I'm sure I will run into that one day, in which case I would pay attention. Yes. So yeah, haven't crossed that bridge yet, but I can see it happening.
okay, yeah. And in terms of like macroeconomic factors like inflation or interest rates or stuff like that, do you look at stuff like that? Because that could potentially affect businesses' ability to service their debt and stuff like that. So
Yep. Yeah, I would say I overwhelmingly focus on the individual business and kind of focus on the micro rather than the macro. Although um, I think it was Lee Lu was asked a similar question and basically said, he tends to focus on the micro, but when things get extreme in the macro, you should probably pay attention. And now's probably one of those times where interest rates are going up reasonably quickly, although historically we're still at fairly low levels. Really, we've got inflation that doesn't really seem to be slowing down, particularly like core inflation. So there's a few more extreme things that should be catching people's attention. I guess what I would do though is I wouldn't sit there and try and predict what interest rates are going to do or predict what inflation is going to do. I would say, what's the different range of what's the different range of outcomes, and how does that affect each of my individual businesses? So, if inflation does remain high and if interest rates keep going up, how does that impact Heritage Growth Properties or Thor Industries or whatever? And then just to again give you an example with Thor, it might be that a lot of the buyers of these RV products, they are oftentimes financing their purchases with debt. So if interest rates go up, that's going to make it harder for the end consumer to get into one of these products because their monthly payments or whatever are going to be higher. So I would always be trying to link it back to the individual business context, but yeah, you pay attention when it gets extreme.
Yeah, I think that makes sense. Um, what is your kind of Oh, one thing I was gonna ask is about New Zealand specifically, I guess. What is the, macro look like there in terms of like inflation and interest rates, currently at
Yeah.
least. I really have no knowledge.
Yeah, I think pretty similar to most parts of the world. I'd have to look it up, but if I were to just randomly guess, I should probably search it. Hang on. NZ inflation rate. Let's look that up. So we're currently sitting at, I think, 7.3% by the looks of it. That's from a couple of months back. It may be slightly higher now, but we're somewhere in that range. And
Okay.
I think we've reasonably consistently been like um, kind of a 2 or 3 months ahead of what you'd kind of see in the US as an example. I think if you were a US investor trying to figure out what was happening, what was going to happen in the US, over the next couple of months, I think if you just looked at what New Zealand was doing, that would, that would have been a pretty good indicator because we kind of started. We started coming out of COVID reasonably early, although we had reasonably harsh restrictions. We started raising interest rates a bit quicker than a lot of countries did, even quicker than Australia, like our next door neighbor who have um, reasonably similar like economic circumstances, and we probably started to see a decline in house prices a little quicker than or a little earlier than other parts of the world as well. So we, from what I can tell, peaked out maybe November or December last year in terms of real estate prices, and have kind of been steadily coming downwards from there. So pretty similar to a lot of parts of the world, but maybe just a few months ahead on the journey compared to some larger nations.
Okay, yeah, that's interesting. So I guess pivoting to talk about your house a little bit if you want to. I guess like you said before, you're not too interested in the financial aspects of real estate or too excited about it. So does that mean you're not really interested in, purchasing more real estate or something like that?
Yeah, I would never rule it out. I just don't think the prices make sense. Like for a little bit of context, the rental yield on the place that we're living in now, if we were to rent it out, would be maybe 3.5%, 4% if we're really lucky, before you pay any sort of costs. So that's just not that attractive compared to what you could buy in individual stocks. If that equation changed and maybe the rental yield was 7 or 8% or something after we've got a bunch of inflation and house prices maybe come down and we get that double whammy effect, maybe things look a bit more interesting there. But just like quantitatively, I don't find it that attractive at the moment. So would never rule it out. It's just I'm looking for no brainers, and I don't think New Zealand real estate is one at the moment.
Yeah, that makes sense. Why is it? Why are those yields so low? Like, why would the house prices be that high to make that low? Is it just like a space constraint?
Um, I think there's probably some supply issues. I think the other part of it is just like the culture of investing in anything but real estate is basically non-existent in New Zealand. Maybe the past few years have changed that and people have got more interested in shares, but the average like mum and dad investor, I would say, overwhelmingly has built their wealth through investing in real estate and accumulating, 2 or 3 rental properties or that sort of thing. Um, oftentimes doing it through refinancing and using debt to buy the next property and so on. And a world of low interest rates for a long time and steadily increasing house prices has helped them just to do that over and over. And um, yeah, this isn't like a prediction of some huge crash or anything, but it feels a lot like what you'd see, on like the Big Short movie, where everyone's just steadily accumulating real estate, and real estate only goes up, and all that sort of stuff. I mean, even in 2008 and 2009, um, don't have the exact numbers in front of me, but New Zealand real estate, for all intents and purposes, just kind of steadily kept trucking upwards, basically. So we didn't really feel that all that much, and it's kind of just continued onwards. I think if you looked at basic stats like house pricing, or the New Zealand real estate market versus our GDP or something like that, we rank maybe second or third in the world from memory. So um, yeah, we're right up there. I think it's just the only vehicle people have had, so it's steadily shot up.
That's interesting. Has it been has investing in, stocks been getting, I guess, more accessible for people recently, would you say?
Yeah, definitely. I mean, when I made my first US stock investment, I think I paid $90 of brokerage to do that trade. And we now have providers where you can do that same transaction for $3. And on top of that, I remember getting absolutely ripped with the foreign exchange at the time. So that probably understates what I was really paying back in 2018, I think it was. So it's definitely a lot more accessible. Yeah, so I hope that's a good thing for people building kind of more balanced portfolios over time. But it used to be pretty horrific, and actually even outside of, I mean, New Zealand, obviously we've got good access to because we're in New Zealand. Although even up until maybe 2018 or 2019, you're probably still paying $30, 30 New Zealand dollars a trade, which might be 15, 20 US dollars, like to invest in a New Zealand stock even. Um, so that's come right down. You've got pretty good access for New Zealand now, pretty good access for Australia, pretty good for the US. Outside of that, it gets much more challenging. So for me to go invest in the UK or Canada or somewhere in Europe is still quite challenging. So there's a long way to go still, but we've made some pretty big steps in the right direction.
Okay, that's good. It's good to hear. Do you mostly just invest in like U.S. companies, or do you have some? I think you've talked about like some New Zealand companies on your channel before, but
Yep. Yeah, I guess similar answer to the market cap question. Really, I'll look kind of anywhere. So as long as I think I can understand it, I will more than happily put my money in it. So it's just kind of worked out over time that I found more interesting stuff in the US. That's probably a consequence of just the people I follow. I follow a lot of US investors, and the states has 13F filings, which are great for sourcing ideas, and that's just led me to having a reasonably US centric portfolio. But I've got some New Zealand stuff in there as well. I have looked at things in Australia in the past too. That random little oyster farmer I mentioned earlier was in Australia. So I'll look. I'll look most places. It just depends on the opportunity set, really.
yeah, that's interesting. Do you have any investments in India, or do you
I
know much
don't.
about that?
I don't have any investments in India. I have briefly looked at Indian Energy Exchange, which I believe both Monash Prabrai and Guy Spear are invested in, and I haven't looked at the price recently, but they were probably up at least 3 or 4x on it in a few years last time I checked. Um, so I've looked at the odd company, but no, I don't have any investments in India at the moment.
Okay. Yeah, I don't really know much about like Indian companies or anything, but I guess my perception is that India is growing really quickly, and I think it's going to be um, a big deal soon. I think they're expected to pass like China in population sometime really soon. I think it was, just a few years ago, people thought it was going to be like 2030 before that happened, and now it's supposed to be like 2023 already. So
I have seen the birth rate in India is through the roof compared to most parts of the world. So
yeah,
that's definitely a big tailwind for the economy, I suppose. But I do know there's been, I guess, similar to when people talk about investing in China, there's been a lot of concerns about potentially, um, running into corruption issues and stuff. So I'm sure that's something that'll get ironed out over time. Um, but yeah, that'll be a very interesting one to watch for the next few decades.
yeah, that's something where it's like I feel like that would be interesting to invest in, but at the same time, like you said, there is like risks there, so you can probably do very well like without worrying about that as well. So
Yeah.
that's kind of my thoughts on stuff like that. Like China as well. Like I think there's probably a lot of good opportunities there, but I feel like there's probably a lot of good opportunities, if you don't include that, and then you don't have to worry about that kind of risk. So
Yeah, I mean, you don't need to find a lot of good investment ideas to do well. I think if you can find, yeah, one or two a year or something over a long period of time, that builds into a reasonably well developed portfolio. So yeah, and you can do it in all sorts of industries. If you want to be a real estate investor or a oil and gas investor or a tech investor or whatever, it all sort of works as long as you understand the businesses.
yeah. So what is your strategy for selling stocks? Have you sold stocks? Do you do that often? What do you kind of look at there? Is it yeah,
Yeah, sure. I would probably break the portfolio into a couple of different types of companies, like the 50 cent dollars and then the better businesses. So, with the 50 cent dollars, basically, if the price got to 90 or 100 cents on the dollar, I kind of just clock out and move on to the next thing. So, that one's a lot more straightforward. It's a lot more quantitative. With the better quality business, it's a lot more complex. And I don't think you can look at. Kind of selling that particular company, just on the merits of that company and the price of that company, if that makes any sense. You have to look at the broader context of other opportunities. So you have to make the decision about whether, if I do sell this company, do I have somewhere to put that money, or is it just going to sit in cash, or, um, all those types of things start to come into the equation. It can become a lot more complex. I'm still, I'm 27 at the moment. My like annual savings are still a big contributor to my portfolio each year. So I've typically been in a situation where if I want to buy something new, I've kind of got the cash to do it. But as this annual savings become a smaller and smaller component, presumably over time, then I'll probably have to be, a bit more of a harsh grader with selling things, I guess. But yeah, with the better businesses, if it got ridiculously overvalued and I just can't see myself getting any sort of return over the next 5 or 10 years, then I'd be out. If something fundamentally changed with the business that kind of broke my investment thesis, I usually have a checklist I go through, and that contains a few kind of core metrics that I would keep an eye on moving forward after I buy a stock. So if any of those things fell over, I'd be out. But yeah, selling's way harder than buying. Even when you're looking at insider transactions and stuff, which I pay a little bit of attention to. For companies that I'm researching, have people on the board been buying in the open market, or the CEO or whoever. There's basically only one reason that people would buy those stocks. It's because they think it's going to go up over time, pretty much. But there can be lots of reasons that people sell stocks. It's just, yeah, there's a whole lot of things that could be going on that could be completely unrelated to the underlying company. So I don't know if that really answers your question, to be honest, but there are a few things that
yeah.
I
I
think
think
about.
it makes sort of sense. Like you said, it's a complex issue, and there's not going to be any um, like blanket answer, I guess. So yeah, I think that makes
Yeah.
sense.
If you're like an old school Ben Graham type investor where you're just buying nets at, buying stocks for less than the cash they have on their balance sheet and stuff, it's a lot more straightforward and quantitative. But Yeah, I don't have a portfolio of those, unfortunately.
Yeah, I think I was listening to some type of book that was talking about Ben Graham a little bit, and um, sort of how like those opportunities just aren't available now because of like the information available, and you know that was kind of the case just because people just weren't really as aware of things going on in the stock market per se, and there wasn't as much information out there. So
Yeah. Yeah. And if you do find them, I know Pabrai bought a basket of Japanese stocks a few years back because they were net nets or at least very close to it. Um, and yeah. And a lot of those like very deep value situations, I think there has to be um, the capital allocation has to kind of align as well. So with those Japanese companies, for example, Pabrai was investing in them, um, but it was almost like a bit of an illusion how, how cheap those things were because the company had no intention of ever paying the cash out. You know, they wanted to survive for the next 200 years and that type of stuff. That was their goal rather than generating significant shareholder returns. So um, you have to pay attention to that type of stuff too.
yeah, that makes sense. So one thing that I invest in, I guess a lot of my individual stocks are focused on dividends a little bit more. So you have any thoughts to share on that? I've heard some interesting, I guess, perspectives from different people about that, and the advantages or disadvantages
Yeah,
of
sure.
dividends.
I don't know the stats off the top of my head. I think I've heard Kevin O'Leary maybe talk about it, but dividends, I think, over a very long time period, like 50 or 100 years, account for a pretty substantial chunk of the total return you get from stocks, I think, at least if you were to just buy the general stock market. So there's definitely a time and a place for them. My preference would be to buy a company that has good reinvestment opportunities. So, if a company takes a dollar and they pay it to me as a dividend, I then have to reinvest that dollar. Whereas if you're someone like Costco, for example, and you've got a dollar and you've still got the capacity to grow your store count, for example, you can put that dollar towards opening more Costco stores. And again, I don't know the numbers off the top of my head, but let's just say that Costco's return on invested capital is say 20%. I think it's probably in that range, maybe even slightly better actually. um, so if Costco has a reliable investment option where they can continually take cash flow and invest it at 20% a year and keep kind of growing the snowball, that's what creates a lot of earnings growth and a lot of capital gain over time and the stock price of Costco. So if that's an obvious option, I would much prefer Costco do that than to pay me a dividend and grow slower, I guess. The other option after that is buybacks. So if there's no good internal reinvestment opportunity, but the underlying, you know, um, core business is trading at a cheap price in the stock market, then I think buybacks can be a really good option, although it has to be done at intelligent prices. Um, they can create a lot of value if you buy back shares below intrinsic value, and it can destroy shareholder value if you buy back stock above intrinsic value. If anyone wants to study like the master of that, you'd want to look up a guy, Henry Singleton, who ran Teledyne for several years. He's written in a book. He's written about in a book called "The Outsiders," I believe it's called. I'm forgetting the author's name, but um, yeah, Henry Singleton was like the master of using his share capital. He actually grew the business by basically issuing stock at these are not the right numbers, but you'll get the general idea. He was like issuing stock at 20 times earnings to buy private businesses at 10 times earnings. He was kind of using that like arbitrage. And he did that for a long time and grew Teledyne massively. He grew the number of shares outstanding, but the per share earnings still went up a lot because of that kind of arbitrage situation. And then he completely flipped the switch and bought back 90% of his shares over the next couple of decades or something. So if you want to read about a master of that kind of dark art. He's a good guy to look at. So yeah, beyond internal investment, buybacks make sense. If you've got no reinvestment opportunities and your stock's expensive, that's when I would prefer to get paid a dividend. Yeah, there's tax advantages to buybacks over dividends because, particularly in the US, company pays corporate tax and then you pay tax on the dividend. Personally, which we actually interestingly don't have in New Zealand. We have something called a dividend imputation credit, where the company's already paid their corporate tax, and we get a tax credit alongside our dividend payments to reflect that, so that we don't have that double taxation like the US does. So that makes dividends a more popular option than buybacks in this part of the world. But that's the way I generally think about it. They're kind of the three options I see a company kind of has with their cash flow and how I think they should kind of work through it.
Yeah, I think that makes sense, and I think that's something that um, I've kind of been learning more about recently. I think initially I was maybe just looking at the dividends as like a not necessarily like a sure return, but I think for me, from like a psychological perspective, it feels better because you're, you know, kind of realizing your return over time, and you also don't really have to like sell per se to realize some of that return, and it's it's kind of like emotionally maybe better, and I think it probably requires like less less knowledge maybe. I don't know if I would say less knowledge, but like um, you kind of know what you're getting, and the numbers to me seem more um, truthful. Whereas if you're looking at like a business and trying to assess, how quickly they were growing, like their return on equity or something like that, how quickly they're compounding internally, kind of external or um, not looking at the stock price per se. Um, it just seems like there's a lot of things that can happen there that can kind of skew the numbers one way or the other, and sometimes it seems difficult to get a good handle on what that really means to me. But I don't know.
Yeah, no, that's fair enough. I get that from a psychological perspective. I guess you just have to keep in mind that if, again, just use Costco as an example, if they pay $1 to you as a dividend, that's $1 they can't reinvest, and the stock price will go up less to reflect that they've paid you a dividend. So it depends what form you want to get it in, and arguably that dollar, if they have got reinvestment options, is actually worth a little bit more because it's more tax efficient to
Yeah,
pay capital gains as opposed to tax on a dividend. So yeah, if you can stomach the lumpiness, then reinvestment is a good way to go, or buybacks can be a good way to go. But if you want steady income, um, I guess that's where dividends come into the picture. But I mean, I have no intention to spend any dividends that I get paid on
yeah,
going out to fancy dinners or anything like that. It all just gets reinvested. So I don't particularly care if I get paid a dividend, at least right now. And I mean, even if you were like, for example, a very long term owner in Berkshire Hathaway, if you just sold 3 or 4% of your, if you converted across to fully B shares or something, and you had a huge portfolio of Berkshire B, and you just sold 3 or 4% of your Berkshire stock every year to, have some cash to live on. Berkshire's compounded at much greater than 3 or 4% a year. So even though you've got less shares, your portfolio is still going up. That's kind of another way to do it, to almost pay yourself a dividend
yeah,
as well.
yeah. I thought it was funny you said something about like using dividends to go out to eat or whatever. Because I was talking to someone else, a family friend, and he was saying he's been investing in Disney since like the late '80s, and at some point he was getting like thousands of dollars a quarter from Disney, and
Yep.
he said he didn't like reinvest any of that. He would just like use it as like fun money or whatever, because
Yeah.
I guess he just didn't know what he was doing as much per se, or
Hmm.
didn't think about it like that. And he said that's one thing he would have done differently, I guess. So
Yeah.
I just
Well,
thought that
it's
was cool, but
yeah, for sure. I mean, that he's probably got a boatload of money in Disney by the sounds of
yeah,
that, but it'd be a lot more if you'd reinvested the dividends or if they'd put it towards buybacks.
Yeah. I
Yeah.
think he said the price he initially bought at was like similar to the price it is today, but it's split like 12 for 1 or something like that
Right.
since then. So
Okay. Yeah. Wow.
it's it's a lot better than it looks, I guess. But
That's cool. I really like those stories of people that have just held on
yeah.
to good businesses for a long time. I hear, I think it's Bill Brewster on the Value After Hours podcast, sometimes talks about one of his grandparents investing in Coca Cola and being up like 100x since since buying. Yeah, those stories are pretty nuts, but shows the power of long term investing, I guess, in good companies.
Yeah, I don't know if you've read the book oh, what's it called now? 100 Baggers,
Yep.
but yeah, they that guy talks about some similar stories of people just, just average people really just like buying these companies and sitting on them for a long time. And
Yeah,
there's that,
it's
yeah, go ahead.
I was just going to say, yeah, it's very cool to be able to do that. It's like the two things I got out of that book is like obviously you need a lot of long term growth, but paying a reasonable multiple of earnings helps as well. They're sort of the two engines to grow,
Yeah.
as if the PE goes up and the earnings go up. Yeah, it makes it kind of a higher bar if you pay 100 times earnings or something, and it
Yeah.
goes down to 25 over the years. The company has to grow its earnings 4x for you to just stand still in terms of stock price. So if you can get both those engines working in your favor, that works out really well.
Yeah. Are you, I guess, I don't know if I would call this a view, but would you kind of align with the Munger view or idea that, over the long term, the stock price will grow at the same rate as the earnings?
Over the extremely long term, I think yes. Yeah, basically, I agree with that. If you pay an extremely high price, that's gonna hinder your earnings, and yeah, I try to avoid situations where you can get it handed to you by the multiple coming down a bunch. So yes, I think your return will probably align pretty closely with. I think the return on equity is what Munger talks about over the very long term. But if you pay 2 times book value and it comes back to 1 times book value over the years, you'll do half as well as you would have done, buying it 1 times book and it stays at 1 times book, as an example. So yeah, price still matters, but yeah, I don't know. You can pay a lot for a company that just grows forever. If you'd
Yeah.
paid, I don't know, if you'd paid 80 or 100 times earnings for Costco in the 90s, you probably still would have had a good result, if I had to guess. But you also would have had to have confidence in Costco growing at 20% a year for a couple of decades, which is hard to predict.
Yeah. That's the thing with some of these companies like Tesla and Amazon, like they still just have such high multiples and it I mean, yeah, I'm sure they're going to grow quickly, but if you're like buying at that price, you're just at it just seems to me like you're at such a disadvantage to begin with. But
Yeah, I think
I don't know.
yeah, they can certainly still work well, but you're handicapping yourself a little bit.
Yeah. So I guess you talked about your goals at the beginning. Um, have those kind of changed over time, and kind of what are you looking at, moving forward? Do you think anything's going to change with your current strategy or what you're kind of doing now?
I don't see a lot changing in terms of like investment philosophy, really at all. Yeah, the goal is still to get to financial freedom, so trying to truck along and do that, as quickly as I can without taking ridiculous amounts of risk or anything. And I feel like value investing is a pretty good framework to kind of do those things. So that still definitely remains the goal. I think I've grown a greater appreciation for just like the kind of the game of investing and like the treasure hunt of finding companies. So even if I, get to that point, I don't see myself stopping investing or anything. I kind of like that's something I like to do. But yeah, the goals really haven't changed.
You mentioned risk. Kind of what is your strategy for risk? I mean, obviously I would assume you don't really mind like, short-term fluctuations in the stock price, but um I guess how do you handle risk in general? Is there anything you do particularly to handle risk or think about risk or try to
Yeah,
quantify it?
yeah. I mean, the like textbook answer to minimizing risk is diversification, and I agree that some diversification is useful. I also am a pretty yeah, I also have a pretty strong view that concentration can be quite useful too. Um, so I think you need some element of diversification, but I think you can pretty quickly diversify. I think that's Peter Lynch term. Um, I saw a study not too long ago that the benefits of diversification. There's diminishing returns, so going from one stock to 10 stocks has a massive impact on just the general volatility of your portfolio, and there's a lot of benefits of diversification to doing that type of thing. Going from 10 to 20, I think the gains you're probably getting are pretty marginal, and going from 20 to 100, you're basically just in an X at that point, and I don't think you're getting much out of it. So I think there's a limit. So diversification is kind of one way, but I mean, a value investing framework is like a naturally risk mitigating like strategy. You're trying to buy something at a margin of safety to where there's like asymmetry between the downside and the upside. So if you can find those situations, that's a naturally kind of risk mitigating approach. um, and that's yeah, that's pretty much the way I tackle it. I don't really care about short term volatility at all. When I first got into it, I would say that to myself, and I would read people talking about volatility not not being something that should affect you or whatever. I think it probably did affect me a little bit in the early days. Now I just I don't know. I feel uh, less and less emotion when it comes to volatility over time. So if something gets cut in half that I like and the business is still doing well, I'm like genuinely very excited about that because I can now put more money to work in it, which is like a really weird characteristic to have and something to have. It's almost like trained yourself to do, but um, yeah, that's kind of where I'm at with it now.
Yeah, that makes sense. Do you have or what? How many companies do you have in your portfolio right now? If you're willing to share that, if you know
Yeah,
that,
good
or just
good
a
question.
ballpark, I
I
guess.
think I think I'm at 5 or 6 from memory.
Okay.
Um, Somewhere around there. Yeah.
And do you, continually add to some of those companies over time if they're continuing to at get to better prices?
Yeah, I mean there's some that I bought in 2018 that I bought last week as well. And there's some that are newer, and there's actually one company that will probably be getting added to the portfolio pretty soon as well. It's one I've been following for most of the year, and it's finally got to like a target price, which is exciting. Um, so yeah, I will continue to hold it. I've got one stock in my portfolio that I think I bought in the 60s. I've written it as low as 30 and as high as 150, and it's about 70 or something at the moment. And I've had transactions in around all those prices. So um, yeah, don't mind adding to things and kind of going along for the ride as long as the underlying business is doing well.
Yeah, that makes sense. Well, I guess, do you have any questions for me?
What's the plans with the YouTube channel and podcast and everything moving forward?
Well, I'm just gonna keep going, try to be consistent. I think I want to, continue doing these kind of podcasts and just talking to people. I really, for me, you know, I'll say this just like selfishly, it's very helpful and interesting to talk to other people and hear their thoughts on things. And like I learn a lot from that. And I think it's also, a good opportunity to share that with people. But um, actually, recently I've been, posting a little bit less on YouTube. I've just not, it's not been as high a priority for me, I guess. Trying to do like once a week at this point, but just have some other stuff I'm trying to spend time on as well. But yeah, I think just be consistent and keep trying to improve the quality over time, and do these podcasts. I think initially, at the beginning of the year, when I kind of started doing these podcasts or live streams, I wanted to do once a month, or I had like the goal of doing it once a month, I guess. And then you know, through some of like the spring and summer months, I was doing almost one a week. And, you know, to some degree that was good, but it was also, more taking a lot more time. So I think now like
Yeah.
slowing down a little bit has been helpful as well. So
Hmm.
yeah, I guess not much. I don't think anything will change much. Just keep going with the current trajectory.
Yeah, yeah, cool. It's a funny thing, really, the whole content creation, because I think most of us go through like ebbs and flows of being really motivated to do it and having lots of content ideas, and then the complete opposite. Like I've had a couple people, you know, that I know recently start YouTube channels, and I'm certainly no like YouTube expert at all. I have a pretty, small channel compared to a whole lot of people, really. But yeah, the one thing I tell them is to like try and be as consistent as possible, and that there'll almost certainly be times where you want to make a whole bunch of videos and release a video 3 days in a row or something. And I tell them like just don't release it, just schedule it for like next week or something, because there will be a point where build a bit of a backlog, because there will be a point where you won't want to make any videos at all, and you'll have this great big gap and video releases, and YouTube isn't a huge fan of that. So um, yeah, it's interesting. And how about long term investing goals for you?
I think, long term, I just want to continue building my portfolio and try to learn, definitely learn a lot more about sort of more the value investing. I guess, right now, um, most of, I guess I would say most of my investments are in just like index funds, but
Hmm.
most of the time I spend investing is in, dividend stocks, being not like buying and selling, but just like buying over time. So I would definitely, like to continue growing that. Right now I'm in college, so it's not like, my income is fairly low. So um, I expect to be able to contribute a lot more in the future. And one thing I kind of struggle with as well is like sometimes I have like, or I'll get a thought in my mind that's makes me think, well, the investing I'm doing right now isn't going to matter much because, in a few years I'm going to be able to, contribute a lot more than I am right now. But at the same time, it's a few extra years at the beginning now could have a big effect down the road as well. So, um,
Yeah, for sure. And like mentally, you if you can get all the dumb mistakes out of the way with small money before you start
yeah,
investing big money, that's a nice way to do it as well. Um, so yeah, no, it's great to start early. I wish I was doing it at university, and had a couple more years there. I was Yeah, I guess I was just in typical university student mode of really not caring about money that much at all, and just having fun and trying to get through a degree. But yeah, it's cool that you've got that mindset, and no shame at all in index funds. I really like looking at individual companies, and I think if you're really almost obsessive about it, you can do pretty well. But indexes is like a pretty pretty reliable way to go.
yeah. I think for me, was just like, well, I probably am not gonna really know what I'm doing in individual companies or investing at first, so I can just put some money over there in index funds and not worry about it and still have it, do well or do
Yep.
good enough if, you know, the individual stocks isn't working or something like that. So,
Yeah. Have you been feeling with I guess with 2022 and presumably index funds being down and that sort of stuff?
um, it's been all right. In terms of the actual index funds, I don't know how much you know about, a Roth IRA, but that's where I guess I contribute a fair amount of my money just because of the amounts that I'm contributing. And I contributed most of that by like May. There's a cap of like $6,000 per year. Um, so, if I had presumably just like waited longer for the market to go down, I would have been able to get better prices and everything. But, again, it's like a long term, especially with index funds, it's going to be a long
Yeah.
term investment there. So I'm not too worried about that. But I think, right now is for a lot of stuff, there's getting to be some good opportunities for sure. So I guess I would say I'm excited about 2022 and how it's gone.
That's good. Yeah, and even if you've got a relatively automated strategy, your reinvested dividends are going to buy more shares and all that good stuff. So, yeah, it's really beneficial actually if prices stay down for a while.
Yeah. All right. Well, thanks for taking the time for this. I guess we can wrap it up here. Definitely, everyone go check out Tom's channel on YouTube. It's just Investing with Tom. And yeah, I appreciate you coming on.
No, thanks for the invite. This was fun.
All right. Thanks. Bye.